Home buying made simple. Why is it simple?
Because we use common sense. Oh, shave it off already. No. All right. Hey guys, George Rivera here and Brian Duckworth. We're the Bearded Brokers for Simple Lending Mortgage, an independent mortgage broker serving Florida and Georgia. And this is our Hump Day update. Guess what day it is? Hump Day!
Good morning, my good people of Florida and Georgia. Brian and George here with you with Simple Lending for a Hump Day update. All right, the three topics we're going to be covering today. First and foremost, as always, your rate update for the day. Next, we're going to be talking about rate rebates. And last, the ever controversial 2-1 buy down. All right, but first, here's George with the rate update.
All right, and for today's rate alert, repricing risk is moderate. The sentiment shift in bonds has been confirmed with today's strong start, opening the door to truly cautiously floating all loans for now. We have to be worried of Friday's PCE inflation data, but otherwise, signs are starting to point to a settling down in rates. I don't think we'll see big improvements necessarily, but we could see better rates and pricing to come. So let's be very cautious in what we're seeing. Today, we're seeing some alleviation again in rates. So we see some drop from what we came from last week. Yesterday was the sign. Today is confirming that for us. If you see something good for your client, let's go ahead and lock it in today. Cautiously float going towards the end of the week because we may lose that. But we are starting to see the settling and we're starting to see signs of better rates to come. Thank you. All right, and that was today's rate alerts. Now that we're talking about rates, just to go ahead and use some supporting illustrations on what we're seeing today with the rate of alleviation, we're actually pretty excited about this. Let me go ahead and share. All right, so this morning we went ahead and priced out VA purchase, $300,000 sales price, 0 down, first time home buyer, funding fee finance, and with as little as a 680 FICO. Today we were able to price that at a 6.5 with a 6.990 APR, slight $454 in discount points. That is huge because rates have pushed us to find a par rate into the sevens. Always think of par rate being the golf term, which means the break even, no discount points and no rate rebate. This is actually pretty exciting for us because that 6.5 is giving us the ability to give some purchasing power to our customers. One of the things that we're noticing in the market right now is that we're seeing similar rates advertised with significantly higher discount points. We wanted to go ahead and illustrate this scenario so that you could see the VA, the rate, and I wanted to show you here on the discount points. So the 6.5, it's at a 0.148 discount points, which the dollar value of that is that percentage to the loan amount, $454. If you're not getting these type of rates right now, please take advantage of our second opinion service. It's a no commitment, no credit pull, no application. We just ask for some very minimal information from you so that we can go ahead and price for you, so we can let you know what rate would be offered to you under a loan program based on whatever scenario you're currently undertaking, so we can show you how that could benefit you financially, whether with a lesser closing cost due to discount points, maybe a lower monthly payment, or maybe you are already maxed out on the debt to income ratio, and this can help increase your purchasing power. This goes two ways. If you're already paying 1 point something discount points, and I bring that up because I want to use this scenario right here. We always check with our competitors for our VA clients. Again, this is not in any way trying to bash any of their competitors. It's just that these are the entities known to you, and we want to use the scenarios to know who we're competing against. VA 30-year fixed, 6.5 is the advertised rate, but it's with a 1.75 discount points. The dollar value of that is $5,162 that you would pay at closing to get that rate. We use guarantee rate. We also chose to have very close parameters of the loan structure, and we're showing their VA 30-year fixed with a 6.475 at 1.2 discount points. which is 36.88 that you would pay at closing to get that rate. And New American Funding, their VA 30-year fix, where we went ahead and saw that their advertised 6.125 comes with a whopping three whole points discount points that you would have to pay at closing. So when you compare that to what we're having here, if you were to pay 1.2 points, which is the lowest out of the ones that we've seen, you will be getting a 6.0 with us. And you could imagine how that will go higher out of pocket expense to you. Consequently, from what we're hearing from realtors, feedbacks, and even veteran buyers, is that there's not enough funds for closing costs and discount points. If you're going to pay $5,000 in discount points plus around $7,000 in closing costs, with today's market, with the sellers limiting their seller credit, which they'll contribute to your closing costs, then you would be exposed significant amount. If any of these lenders is going to give you their par rate, which is the rate without the discount points, and if we use the 1.2, 1.7 formula and we go the other way in the spectrum, which means that would put you at a 7.125, 7.25 spectrum, if you're going to get that for nothing, again, give us a call for the second opinion service, because this could translate into you getting a rate rebate of, as you can see here, 43.64, 45.88. So if you're going to get that rate because you don't have the means to pay for it, then at least do it where you're getting compensated for taking that rate, but know that you have the choice to get a lower rate without that out-of-pocket expense. Talking about rates, that is going to lead us into the next topic, which is the 2-1 buy down, which also can help alleviate you in your interest rate temporarily for the first 2 years or 1 year. Brian, take it away.
All right, thank you, George. All right, now we're going to talk about the controversial 2-1 buy down. What is it? How is it calculated? How can it benefit you? All right, so for this scenario, we're going to use the exact scenario that's up there. VA purchase, $300,000 purchase price, 0 down, funding fee finance at a 680 FICO for a first-time home buyer. All right, so the 2-1 buy down is a temporary rate buy down that lets you borrow at 2% less in interest rate for the first 12 months of your mortgage, and then 1% less interest rate for the next 12 months of your mortgage, following up with the full interest rate years 3 through 30. All right, how you calculate it. So let's take this example. 6.5 is the closest thing to par that we have. So that's what we're going to use. So for the first year of the 2-1 buy down, you're going to borrow at a 4.5% interest rate. All right, that's going to save you $385 a month on that payment. How you're going to calculate that, take the difference in the principal and interest payments, which would be $1,940 and $1,555, and you're going to get $385. You're going to multiply that by 12 for the first year of that mortgage, and you're going to come up with $4,620. Now for the second year, the 1 in the 2-1 buy down, you're going to take the principal and interest payment at 5.5%. And you're going to multiply, you're going to take the difference in the two payments of 6.5 and 5.5, which is $197, and you're going to multiply that by 12, bringing you to $2,364. So a 1-0 buy down would cost $2,364, and a 2-1 buy down is going to cost you $6,984. All right. So you can use seller concessions to purchase this 2-1 buy down. So in my opinion, where it makes sense, very few and far between. If you get enough closing costs or enough seller concessions, to be able to cover closing costs and do a 2-1 or 1-0 buy down, in my mind, it's worth it. All right, here's why I think it would not be worth it. Let's say you get $7,000 in seller concessions to use towards closing. All right, you can also use those seller concessions for a 2-1 buy down. However, why would you spend $7,000 more in your closing costs to get the 2-1 buy down? You're spending the money up front to get it piece by piece back over the next 2 years. Doesn't really make any sense to me. However, if you did get enough to cover closing costs and cover the 2-1 or the 1-0 buy down, then it would be worth it in my mind. You could also use that same money to go towards a permanent rate buy down, meaning purchasing discount points. In this scenario, the closest thing you'd be able to buy down to would be a 5.875. Although if you take the difference in monthly payment of $125 a month, it's going to take you 51 months to even out that 5.875 in discount points. So to me, that one's not really worth it either. In this situation, I would personally take the 1-0 or 2-1 if you have enough seller concessions to cover closing and the 2-1 buy down or the 1-0 buy down. But any other time, it just doesn't really make sense because you're just going to come out of pocket that extra money for closing costs that you would have saved over the first year or 2 years in monthly payment. George, you have any opinion on that?
I do. This is such an interesting program because it's creating significant controversy, even among loan officers, different lenders, and banks. So the banks that don't have it, obviously they crap on it. The ones that have it, they love it, and a lot of the loan officers are really skeptical on how to advertise this. And I understand that. I understand its benefits, but just like everything else, when something has pros and cons, it's all a matter of opinion. And I think that you covered something and you gave an interesting explanation. Um, the program in itself is it's a good structure. I just think that the market environment is what's opening the door for this program, but I also think that the real estate market is showing that it's not the proper time for the program. Because here's the thing, again, this is a program that has to be, like you just said, it has to be paid by the seller with the seller concessions, right? So here we come on the market that it was so hot. It was a seller's market, and sellers were not even contributing any seller concessions, right? There was no contribution to closing. So now all of a sudden we come to a big halt in the real estate market. So this is an interesting way to not only help the buyer, but it can also help the seller. But for it to work on both sides, the seller would have to understand that you're not necessarily paying. I had a realtor literally say that whenever she lists her properties for her customers, she puts in the contract that she does not want any of the money to contribute to paying the client's crappy interest rate. And this is just something that you have to acknowledge. In today's market, there are a lot of houses are sitting longer. Days on the market has gone up. Price reductions have gone up. So what do you do when the market is doing this to you? In order for you to bring up the appetite for a buyer or an incentive to sell that home, rather than dropping the price, you have to do a mathematical calculation of what if I don't drop the price, and what if I go ahead and use seller credits or seller concessions to go contribute towards closing costs, but also towards this 2-to-1 buy down. Now, mind you, that this rate reduction for the 2 years is to save money to the customer, but the qualification of the loan, it's still based on the long-term rate. So just because we dropped your interest rate for 2 years on a temporary does not mean that your debt to income ratio is being calculated on that reduced rate. That reduced rate is to save you money for year 1, year 2, and then you go to the long term. So the qualification or the purchasing power is still going to be based on the long-term rate. The appetite is to be able to help the buyer have this incentive. Now, again, to what you said, which is, again, interesting on how long are you planning on living in the house, if you're going to refinance. One of the pros to the program is that because this money is not the same as discount points. Discount points is a dollar value that you pay to acquire an interest rate for the life of the loan. This is actually a paying off on the savings. This money goes on escrow. So this money is being paid to the investor like if you had taken the higher rate, and they're paying the difference for those 2 years of that reduced payment. Because that money is on escrow, if the rates dropped and you were to refinance while you still have unused portion of the funds from that escrow, that money actually goes towards the payoff of your principal when you go to refinance. So you don't lose the money. You actually get every dollar that was spent on that account goes towards you, whether it's to reduce your payment or even towards the payoff if you go to refinance. But I also understand that if in today's market, the seller, for instance, is going to have a 3% calculation rule, and they're only going to give a $7,000 seller credit, and you're going to use that $7,000 to buy that, you are exposing yourself to having to pay $7,000 at closing for your closing costs. And to your point, you're going to be essentially getting that money back at the end of the 2 years, because that money is a dollar for dollar. But it would have to be at that 2 year term that you got that money. But are you going to come out with the $7,000 out of pocket today, so that in 2 years you get your money's worth, essentially, you wash out? Or would you rather just get your fixed rate today and get that seller credit towards your closing costs, so that we can limit your exposure out of pocket today? So I think it's an interesting thing, because I can now see both sides of it, because some realtors, their feedback is more concerning, that as much as they like how it sounds and they want to put it forward, but they find themselves stuck when it comes to the negotiation in trying to get that significant seller credit. And when I speak to listing agents, they also feel that they wouldn't be doing right by their clients if they were prepping them to be willing to come out so much out of pocket, because obviously the realtor's job is to do best for his client and net get the best deal. Whether it's the buyer or the seller, is always to get the best deal. And for you to come out this extra money, I think it's very market dependent, Brian. I don't think it's necessarily for everybody. I think in some of the metro areas, for instance, where you have comparables, if you price reduce a home in this corner, you have lowered through comparables the value of other homes in that existing market. So rather than do a price reduction, which will slash prices across the board within the miles radius, you rather go ahead and say, look, why don't we keep the price the same and use the same money we were willing to give out for seller concessions, and take the money we were willing to slash up the price and just add that together and offer that as an incentive to the buyers, so that the buyer would have an incentive. Now, in some markets, seller credit, it's still not a thing. So when you're asking for this, it's very hard, because it sounds enticing, but it's not realistic to the listing agent or to the seller. It's a meeting of the minds that have to take place. But again, I think the market dictates, and every market is showing different signs. Some are having upswings. Some haven't even haven't seen a drop yet, Brian.
Yeah,
Would
George,
agree.
I couldn't agree with you more. So let's take this same example and compare the two. So if you're going to drop this purchase price down from 300 down to 290, but offer no selling credits, it's going to make a difference in payment of $65 a month at the 6.5% interest rate. However, instead of doing that, if you left the purchase price at 300,000, but then offered $10,000 in seller concessions, you bring that buyer $10,000 in purchase power that they don't have to spend up front. They can use this towards closing costs. They can use this towards discount points. Either way, dropping that price of that home by $10,000, only saving them $65 a month, it's going to take them 154 months to make that $10,000 back up front, as opposed to if they just got it in seller concessions. You still get to keep the purchase price of your home at where it's at, but now you open up so much more room for people to save money up front. You're going to help qualify more borrowers that were not going to be able to purchase that, having to pay full closing costs, and you're going to give them flexibility to use buying power because they have seller concessions.
And remember that when we did the Facebook post here a while back, and we did this, we weren't even trying to touch on the 2-1 buy down. We were literally just talking about, in general, instead of reducing the price, to just go ahead and take that money that you were willing to slash, to use that and advertise. I mean, I think realtors, remember at one point when I used to advertise in the description of a property in the MLS, and you already put out there the seller concessions, the willing amount. This is what is going to bring the appetite back. I mean, I'm telling you, we're getting significant amount of applications, and we're doing a lot of pre-qualifications, and a lot of the difference in between them being pre-qualified and actually finding a home, it's not that they're not interested. It's because there's a few combinations here. There is a high purchase price, there is high interest rates, there's discount points environment with the rates, and there's also a reduction on seller concessions. So now you have a buyer that is buying what they feel is a home that is at their means financially, but it's not at their expectations. Then on top of that, they have to come out of pocket on the closing costs. on the discount points, and they're not getting any assistance. So we have a lot of buyers that they are debt to income ready, but not cash to close ready. So I think what we need to consider is bringing that market back where we bring the seller concessions. And I think that if we openly advertise this, or let just put the word out to bring them. So look, whether we use this to help on the closing costs and the rate buy down, whether we use it with the 2-to-1 rate buy down environment, there are plenty of different assistances out there. As you know, right now we have a lot of builders that are using their in-house lender to create certain pricing incentives. We have builders using outside preferred lenders, and they're establishing relationships so they can also have incentives. The 2-to-1 buy down will be a great tool for, like, for instance, builders who cannot afford to do any price reductions because it would hurt the value of the remaining of the community and the remaining houses that are yet to build. But yet that incentives will cost pennies to the builder compared to a price reduction that will carry across the community. Just the same to any seller. I think that the 2-1 buy down is it's a great tool if it's in the right market. But I also think that ultimately what we're looking at here is that what we want to help the buyer is the combination of the out-of-pocket expense, whether it's closing costs and discount points. And again, we ran that scenario using a 200 and a 210. Without the reduction, the customer was actually going to have a lesser payment and no out-of-pocket cost if there was a 210 purchase price with 10,000 seller, than if the house was reduced from 210 to 200 at no seller, because now you have a buyer that has full out-of-pocket expense and their payment was actually going to end up higher than if they were paying $10,000 more, but at a lower rate. So again, financial literacy is not just for the consumer, it's also for industry partners, because there is going to be a lot of misleading and a lot of targeting of sales tactics. Some of it is just shiny, but it's not gold. Some of it is going to be confusing. Again, I can't reiterate enough, bringing back a second opinion service. Look, we're not saying that we're the save all for everybody, but we are experts in loans and mortgages because of our vast variety of lenders. We don't just learn the programs that are niches to you, like VA, FHA, conventional. We also have, our non-QMs, we have our hard money, we have our commercials. So we have to learn all of these different loan programs. We don't just buy into it, we digest it, because we don't ever want to perpetrate that we believe something is good just because it's being presented to us as such. That's why we did this today and we covered on this topic, because we're seeing a lot of excitement around it, but we're also seeing a lot of controversy. And I think that this is something that is great. It has some pros to it, but there's also some cons. And we wanted to be able to not just sell it, but explain it, let you know we have it, and let you know that we're more than willing to take the time to explain this to you so that you can also explain to your clients. And in any way that we can help educate, at the end of the day, we believe that fortune favors the informed. And I think we're tasked with passing this information and knowledge to you, whether you're a real estate industry professional, whether you're a consumer, or whether you're an existing homeowner. So I think this will wrap up our Wednesday's Hump Day update. That's it for me. Brian, do you have anything else to add?
That's all I got, George. Hey, anybody that has a different opinion or maybe has a comment to bring in, shoot us an email, send us a text, or give us a call. We'd love to hear your different opinions about the 2-1 buy down.
Thank you, guys.